What's going on, Penny Boys and Gals? It's your boy, What the Duck here, and it's time for a bonus live stream. This is our Trading with Tagman live stream. So this is going to be a bunch of great trading tips and tricks for new traders. We're going to bring in one of our great experienced traders, Mr. Tagman. He's going to come in and talk to you about trading with emotions, percentages versus cash. We're going to go over note-taking, trading plans, compounding gains, portfolio diversification, day trading with a cash account, due diligence, and so much more. So definitely be sure to stay tuned, and I'm going to go ahead and bring in Mr. Tagman, and we're going to start this stream.
How's everyone doing?
So, Mr. Tagman, so this is for new traders. Let's just go ahead and start with step one. What do you have to say as far as the emotions in trading goes? Is there any tips or tricks you can give our new traders?
Oh man, Duck, you're right on with that. I look at emotions and I reflect everything on emotions back into real life. How many times in real life have we used our emotions and it's come back to harm us? Whether it be something we said to somebody, a family member or a friend, we regret it later because we're acting off emotions. It happens in trading too. We got stuff that they call FOMO, fear of missing out. We got people chasing stocks that already ran. We got people that don't have patience and just don't have the patience to sit there and wait for a trade. What happens is they sell their stock and it runs tomorrow because they ran out of patience. Chasing because you see a stock running and all your friends are taking profits. I always say to yourself, man, it's better off just looking at your fellow trader and saying, congratulations, good job. I wouldn't recommend ever go chasing a stock because that's what we call FOMO, fear of missing out. Let that stock run, man. It's not the last stock to ever run. You'll get your chance, so you don't have to go chasing it and possibly getting caught on the top end, maybe becoming a bag holder. You bought something too late. You didn't get full advantage of that stock. It's the same thing with me when I go to a restaurant. If I go to a restaurant, I want the full meal. I'm not going to go to a restaurant and order leftovers. Ordering leftovers is like chasing a stock, in my opinion. I mean, it's all part of what you teach in your psychology of trading in Pennybois University, Duck. It's such a big point. So many people overlook that point, Duck.
No, it's definitely so true. I know, like, a lot of time, we have a whole month in Pennybois University going over trading psychology, and I know a lot of people at first are like, oh, like, why do we have to do a whole month on psychology? Like, I want to learn the charts, I want to learn the candles, and then after other classes are over, they realize, like, oh yeah, that was the most important month, because you're right, all about FOMO and emotions is a big part of trading, which is why we go over so much detail in Pennybois.
One step at a time.
Yeah. Speaking of emotions, I know that one part of handling your emotions is being able to differentiate the difference between the percentages and the dollars.
There's a lot of times you look on these social media groups and you see people not understanding the difference on the value of percentages and a dollar. I mean, how many times do you see people say, hey, I've only got $10 to spend and I want to buy a penny stock? It really doesn't matter how much the stock value is. It's the percentage of the value you're going to make on it. Some people psychologically, they think if they have $10, they need to get the most out of it by buying a penny stock. They rather hold 20 shares of something at 50 cents compared to only holding one little share at $10. But they don't realize the 20 shares they bought for 50 cents is $10. They could have bought one share for $10 and there's no difference because by the time they take 10% profit, they're still making $1. That's what a lot of people don't understand and they don't focus on. It's not about how much money you make in the stock market as far as the dollar value. You got to focus on making percentages in trading. The percentage in trading is what's going to grow your portfolio in the long run, and the dollars will equal the percentages in the long term, but you need to focus on where is the percentage that you can gain to help your portfolio grow to become a bigger dollar in the future. But if you focus on the percentage, that's key. My goal is to make percentage gains daily and weekly.
Oh, 100%. Especially percentages, of course, when it comes to, a penny stock versus like a blue chip and all that kind of stuff. But it's, even with risk to reward ratio percentages, you go over in Pennybois University, a big part of your plan. But even before making your plan, what do you have to say as far as note taking goes? Is there anything that you can tell the new traders about note taking and like tracking your trades?
Yeah, what I do for tracking my trades, I try to set myself a portfolio of notebooks. Taking notes is the same thing. If you want to be a trader successfully, you're going to learn from your mistakes and you're going to learn from your success. So I always recommend taking notes because after the trade is complete, you can go back and review your notes. For example, when I decided to buy a stock, I write down the name of the stock. I'm going to write down a little quote. Why did I buy the stock? What did I see that I loved about the stock? Why did I want to buy that stock? Next, I'll buy in there how much of my portfolio did I put towards that stock? When did I make my first purchase on the stock? How much did I allocate on my first purchase? When I made the first purchase, I'll take sometimes a screenshot or I'll just note down what I seen in the candles when I made the first set to get into that stock. My first set of shares, why did I buy it then? What time was it? What was the date? Next, I'll watch the stock. When I put my second bid in there real shortly, I'll note, why did I buy my second set of shares there? Continually till I'm fully invested in that stock. Once I'm fully invested in that stock and I put my final bid in there, what made me go all in at that moment and why? Where did I put my stop loss in that play? Then I'm going to note on there, when did I start scaling out? What did I see that I started taking my money out of the play? Was it that I was taking profits for short gains as far as compounding my gains? Did I see a drop off? What was my reasoning for selling, and how often did I sell? And what did I see in the charts or the current news that made me start selling off? Now, at the end of that trade, I can go back and look at that notes. If I was successful, I can note it with a thumbs up, is what I personally do in my place. I put a thumbs up little emoji on my little paperwork. If it was a negative trade, I put a thumbs down on my trade. And when I get 2 or 3 trade notes or 2 or 3 trades complete, I can go back and look at my 3 good trades. What was my common denominator that made those trades successful? If I failed, unfortunately, sometimes that's good news, because you can go back and look, how did I fail on that trade? What in those notes was consistently going wrong that I made a mistake? If I made a mistake, I could adjust my trading accordingly and go back and look at the notes and see, where was I making a mistake? Was it me? Did I read the charts wrong? Was there a catalyst that beat me? I can go back and see what went wrong on that trade. Anytime you take notes, like a professional baseball team or football team or whatever it may be, whenever they're done with a game, they always go back and look at their notes and see what made them good. Well, either way, you're learning from your notes each and every play.
No, 100%. Even speaking of baseball, I made 50 trades. The 5 ones I lost on, this was, like you said, the common denominators. Kind of like making your own batting average, I guess, and kind of figuring out, how you do versus, in baseballs versus lefties or versus, whatever, the wind's blowing this way. With trading, it's, how I did, maybe when I, didn't get enough sleep, or how I did, when I was buying in too fast for a trade or whatever it may be. And it's good to kind of see what type of trades, work best for you and work best for your trading plan, which is actually what we, is kind of the basis of Pennybois University, is creating your Pennybois University trading plan. And if you have anything, you probably have your own trading plan. Everyone has their, their own different trading plans. No 2 traders are the same. Maybe there's something you can talk about as far as the trading plans go.
Exactly. I mean, with a trading plan, I always try to set I've got basically 2 trading plans that I go off of personally. My most go-to trading plan is very simple. What the things I try to play off of my trading plan is, how much of my portfolio do I plan on using for that one trade? Where do I plan on putting my stop loss on that trade? How do I plan on buying that trade, for example? And what is my goal for getting out of the trade? Well, simply, when I'm trading, I use the golden rule of thumb of 10% on my portfolio, meaning I never use more than 10% of my portfolio in any trade, not putting too much risk in my portfolio in any trade, lowering my risk. So 10% of my portfolio per play maximum. Next, I usually decide personally to put my stop loss at the end. That's something somebody with lower risk will put their stop loss at their first bid. Somebody with medium stop risk factors will put their stop loss in the middle. And somebody that's looking to average down and has a little bit more risk tolerance, they'll put their stop loss at the end. My buying ratio, I personally usually use a common buying ratio of 25%, 25%, 50%. And my goal is to always scale out of a stock on the way through the stock, taking guaranteed profits when I see them available. So basically, if I had a $10,000 trading account and I was using the maximum potential of my trading account, which is 10%, that allows me to use $1,000 of a $10,000 trading account. If I was going to play Apple as an example, and I seen Apple trending at $1, and I thought I can get $1.20 out of that Apple purchase, I used a 25, 25, 50 buying rule. I'll buy 25% of my shares looking at the slight consolidation, and I'll buy 250 shares of Apple at $1. After that point, I'll just go back and look at the chart, and I'll just follow the chart closely. I'll watch it real close, pretend I come back and it's dropped support. If it drops support, I'm not going to panic, because I decided to put my stop loss at the end of the trade. So as it's dropping, I'm not getting any of those emotions we talked about. I'm very calm, cool, and collective. I know my plan. I'm going to stay to my plan. As it drops down, I'm going to wait for it, and finally it stops dropping, maybe 2 hours. It could be 2 days later when it finally stops bleeding. But I won't add any wood to the fire at this moment. I will not add any more shares till I'm sure it's at a bottom price. Once I see it consolidating once again at support, I'll watch it closely. I'll watch everything I learned over the years, the same thing that's taught in Pennybois University. I'm going to wait for a consolidation to build up. I'm going to wait for a sign of reversal. I'm going to watch the bottom Bollinger Band. I'm going to wait till the VWAP bounces off VWAP the price. I'm going to wait till it goes off the bottom Bollinger Band or whatever you're deciding to use in your charts. As soon as I see that solid consolidation coming in and the buying pressure coming in really heavy, right there at that point of a confirmed reversal, I'll add another 25% of my shares. Let's pretend we're 50 cents. I just bought another 250 shares of Apple, 50 cents. That went alongside my first set of shares that I bought originally and opening at $1. That just dropped my average down to 75 cents. I'm in a lot better position now. That was typically what we call averaging down. I personally add my final bid on the uptrend. As it's uptrending, I'm back at 75 cent average. I am personally waiting when it gets back up on that trend. Bam, as soon as it gets to 70 cents, I'm really focused because I found that the trend I was looking for. It's very solid still. As it goes up right here, it hits 75 cents. As it hits 75 cents, which is my current average at 75 cents, right there, I add my final position, my final 500 shares of Apple. Bam, lock it in. Now I'm 100% invested. I personally put a 5% stop loss at 75 cents. So basically right now I'm even money on my trade. I didn't lose any money. By the time I get my final set of shares in, once I'm 100% invested, I'm even money. I'm not at any loss. As it's uptrending and it gets back to $1, which is my original entry, right now at this point, I'm worried about compounding my gains. I sold out 25% of my shares, $1. That was the average person's buy-in, but I sold 25% of my shares. Next, as it's going up a little further, it gets to $1.10. I'm going to sell it another 25% of my shares, again, working on compounding gains. As it gets to $1.15, I'm going to sell another 25% of my shares. And now I'm out 75% of my shares. As it gets to that $1.20, which was the estimated target price that I was looking for at $1.20, I'm personally selling another 15% of my shares. Now I'm out 90% of that trade. What I do at this point is I put a 3% trailing stop on that trade. But what's great about that is I protected my downside by buying in slow. But what happened, people ask me sometimes too, hey man, that doesn't work for me because at your first 25%, what happens if the stock runs? Well, that's great actually, because you're only 25% invested. If you go back to our first purchase, you were 25% invested. I bought 250 shares of Apple. That's great. Yes, it didn't drop to support, but what it did is it consolidated heavy and it took off from that $1 entry. So what happens is you entered at $1, 25% of your shares, and it went up. Congratulations, you protected your downside. So what did you do? You took guaranteed profits on 25% of your shares. You were not fully invested. That's fine, but you still made profits. That's what matters. You're also protecting your downside for being a bag holder by going in, let's say 50 to 75, or maybe some people go in all in on their first buy. All that's doing is putting you in danger. Putting you in danger in that trade is something you need to protect yourself by buying in slow. Yeah, Duck, for sure. That compounding gains is key. That's what it's all about.
Yeah, especially when it comes to, like you said, protecting your downside, or you're protecting your risk, which also another way of doing that is diversifying your portfolio. Especially new traders might not understand what that means. A lot of them like to go all in on a stock, because that's just what they think it's supposed to do. But as you know, that's definitely not the way to go when it comes to having a bankroll strategy. So when it comes to selling, selling early, or whatever it may be, whatever fits your plan. I know you, like you were saying, you sell early. Some people might do what works best for them. But why is it that you try to do that method as far as the early selling goes?
Yeah, that's always part of my plan, because I look at it this way, Duck. I always like to keep my money, the most of it I can, in rotation. When the money's sitting there, it's really not doing nothing for you. And sometimes that's part of that greed of emotions. Some people get greedy. And what happens is, you can look at it this way at the end of a season. I call a season a trading year. At the end of the trading year, I'm looking to win the World Series, for example. If I want to win the World Series, I need to plan ahead now for the end of the year. You need to start now. You don't worry about it 11 months into your trading season. So you worry about your trading season now at opening game. In trading, we're going to have wins and we're going to have losses. We may lose a game once in a while, but at the end of the season, our goal is to win the World Championship, which is the World Series. In baseball, the key to baseball at the end of the year, you're going to have two recognized players. You're going to have your home run king, and you're going to have your most valuable player. Your most valuable player is always a higher paid player. Now, your home run king, is he a great player? Absolutely. Your home run king is a little more greedy. All he worries about is getting up to bat, smashing the heck out of the ball, and he's worried about making home runs. Does he make a lot of home runs? Absolutely. He gets a ton of home runs. Congratulations. It's amazing. At the end of the season, that home run king has a great batting average of a 280, which is a good batting average. He makes good money at the end of the year. He's paid well. Great job. Now, who makes more money at the end of the year? Your most valuable player makes the most money. Why does your most valuable player make money? Because your most valuable player is a teammate. But as a trader, your teammate is your portfolio. So how do you want to make your portfolio succeed? What the most valuable player does, he's got a 400 batting average, not a 280. How did he do that? How did he make all those gains and not hit home runs? Well, What he did, he was consistent. Every time he got on bat, he wasn't trying to smash the ball, run for a triple. He wasn't going for a home run. He was not getting greedy with the bat. All he was doing is making a simple swing. His objective was being consistent, making consistent base hits. If he can make a base hit of a 5% runner or a 10% gain, that to him is a home run. 3%, 5%, 10%. Get to first base, successful. He's always getting to first base almost every time at bat. Now, does he hit a double? Absolutely. He'll get a 20% runner every so often. Will he hit a 30 to 40% runner once in a while? Absolutely. He's going to get it. Will he get a home run? Yeah, he's not going to get a lot of home runs, your most valuable player. But yeah, the wind is going to line up. He's going to have a perfect swing. That pitcher is going to throw him a perfect ball. He's going to hit a home run. So you're still going to get a home runs in time. You're going to get that mega runner. But your main objective needs to be, let's just make consistent hits. Let's pocket 3% and 5% runs. So many people are up 3%, 5%. They get greedy because they want more. And what happens? Now they're down 2% because it dropped a little bit. Instead of taking that 3% profit, they took a 2% loss. So technically, you lost 5%. Here's something to think about. If you could download a compounding gains calendar, you could put $3,000 in a compounding gains calendar. You're going to start with $3,000 on a compounding gains calendar, take 3% weekly gains. In 3 years, you're going to have well over $300,000 from a small $3,000 trading account taking 3% weekly gains. It's pretty simple. If you can stay focused and dedicated compounding your gains, everybody as a trader can do the same thing. It's a proven fact. Gotta be committed in yourself, Duck. These people, if they're committed, they can do it for sure.
No, 100%. And yeah, compounding gains is like risk-reward ratio. It's all about risk management. But as far as risk management goes, portfolio diversification is something that a lot of new traders might be aware of. They might not even know what the word means, when it comes to portfolios.
Yeah, I mean, Duck, you're absolutely right what you guys talk about in Pennybois University. Being diverse in your account is big because there's a lot of people that are trading nowadays, and you could see them. There's some newer traders, and there's some seasoned traders that make this mistake too. And it's very easy to overlook. You can see some people putting their portfolio, and even if they're holding 4 or 5 stocks, they're holding nothing but, say, pot stocks. Somebody's just so confident in the SPAC sector, they invested all their money in SPACs. Or maybe they're into oil and energy, but they're 100% of their portfolio, all 5 of their stocks are sitting in an energy field. The problem with doing that is you're not diversifying your account. So if energy doesn't move today, all you're doing is looking at your stocks while other people are taking profits. I look at it this way. It's just like fishing. If you go to a fishing pond and you bring one fishing pole, which is one sector with you, you're only going to play one part of that lake. You're going to sit under that willow tree. You're going to have low percentage of, chances of getting that fish. If you want to up your percentage and take a better chance at making gains, better your value, I always suggest playing more sectors. If I was going to show up to the lake the next time, I'm not going to bring one fishing pole. I'm bringing 5 fishing poles. I'm going to play my favorite spot under that willow tree. I'm going to put one of my rods over there by the waterfalls where it's got more current movement and with the water. I'm going to put a hook over at that deep end for sure because there's always big Harry sitting on the bottom. Now I'm going to play a little something maybe in a shallow end where the sun is shining. So I'm going to play, say, 4 different sectors. I'm going to give myself a better opportunity to catch fish, which is a trade. So I'm not going to put all my money in the SPAC sector, for example. I'll put a little bit of my money in the energy sector that I love. I'll drop something over there in the tech area. Sure. I'll put something maybe in a COVID play. Why not even travel? If once this COVID lifts, I may want to play something in the travel industry. Everyone's looking to go traveling again. So I'm going to diversify my account and I'm not going to play one sector, say energy. I'm going to keep one in energy. I'll throw something in maybe at a SPAC, something in the travel, something in retail. I'm going to diversify my account. So if something's moving today, it's moving, but that's something that is moving today may not move tomorrow. You may have a better chance of scoring on something else that's moving tomorrow. Diversification of your account is pretty key. And that's one thing I learned from Pennybois University also is diversity, and something I've learned over the years. I've learned to never play one field. I need to move my money around different areas, have hooks set in all corners of the market at all times.
No, that's definitely really, really important. And it's definitely, a great tip maybe new traders might not know. Speaking of which, I know a lot of new traders, they probably get into the market, they see all these people making money day trading, and they think, oh, I wish I could do that, but I can't because I either A, don't have 25K in my account, or B, I have a margin account where I have these day trading restrictions. So what could a new trader do in the market when it comes to day trading if they don't have $25,000 just laying around?
It's a good point, Doug. Not everyone's fortunate enough to have $25,000 in their account. But what's also overlooked, in my opinion, is People look at day trading as just making money. My opinion is a day trade is also a weapon of security. How many times have I've seen people, and it bothers me, that say, hey, I have a stock, it's gone up 60%. I can't sell it because I don't have a day trade available. That hurts me to look at. Or possibly somebody has a stock, if they're up 60% on a stock, they could have secured profit, but no, they don't have a day trade, so they cannot take profit. Or there's times, unfortunately, where bad news is dropped and they can't save their stock and save their equity. They can't save their money because the stock dropped and they can't get out of it without taking a penalty, and they're afraid to take a penalty for whatever the reason may be. So day trade is also available as a security guard, as a weapon to secure your money safely. But as far as day trading, if you have $2,000 or $5,000, you can still day trade, say 20 to 30 day trades a week if you're allocating your money correctly. The way I suggest people do it is up to them to follow this golden rule, but it's very simple. If you set yourself up as a cash account, once you transfer your account to a cash account, wait for all of your funds to settle. Once your funds are settled 100% in a settled funds column on a cash account, you can start this allocation. If you stay on this rotation, you will have zero issues. So basically now your account is set up as a cash account. All your funds are showing 100% settled. Once 100% of your funds are showed settled, you need to allocate 30% of your funds for Monday. Take another 30% of your portfolio, allocate it for Tuesday. Take another 30% of your portfolio, allocate it for Wednesday. Now you have Monday, Tuesday, and Wednesday allocated 30% of your portfolio per day. You have 10% of your account left. 10 it does not exist. You should never be all in on your account at any time. So basically now Monday morning opens up, you allocated 30% of your portfolio. As a trader, what I would do is I would play, if I like the market and I'm strong, I got 30% of my portfolio sitting there. Monday morning, I'm loving the market. Using that 10% rule as a good trader would never use more than 10% of their value in any one trade. So using that 10% rule as a maximum, I can do 3 day trades on Monday with 30% of my account. 3 day trades at 10% apiece, which is maximum risk. At the end of Monday, bam, I sell 3 day trades, no penalties. Now Tuesday comes along, I have another 30% of my portfolio I allocated aside to keep in rotation. Tuesday morning, the market opens up, it looks a little slower. We're seeing a little pullback today. I'm not looking to risk the full 10% in each play maximum. I'm going to play 6 day trades today instead at only using 5%. So I'm going to use 6 day trades at 5%, which equals my 30% of my portfolio on Tuesday. At the end of Tuesday, bam, I sold all 6 of my day trades. I have now taken a total of 9 day trades with 0 penalties because everything is settled cash. No good faith violations, no pattern day trader restrictions, nothing. Now Wednesday morning opened up. Yes, my 30% of my portfolio is still sitting there available to me because I allocated that early in the week to keep it in rotation. So Wednesday morning when the market opened up, it looks a little stronger. I'm liking Wednesday already. I'll play 3 more day trades today, 10% a piece, lock them in 10%. I've taken 12 day trades to date. Now when the market opens up Thursday morning, where's my money? I only allocated Monday, Tuesday, and Wednesday. So now Thursday morning when the market opened up, my money is back there. How did my money get back? The money I sold on Monday was back in my account on Wednesday. This way at 4 o'clock in the morning on Webull, my account was available, cleared on Wednesday, and it's sitting there Thursday morning ready to go. Let's play another 3 day trades. It looks strong here. I'm going to play 3 more day trades today at 10% a piece, lock it in, and to Thursday, I will sell 3 more day trades, 10% a piece. That is a total of 15 day trades. Now, Friday morning opens up. It might pull back a little bit, but I personally don't risk a lot in my plan because I don't know what happens on Friday. Sometimes we have a little pullback. There might be news over the weekend. So some of these stocks might dip a little bit during the day potentially. So today I'm going to play less risk because I'm only looking for short gains to compound my gains for my week goal. I'm going to play 6 day trades at 5% a piece. Where did that money come from on Friday? You're going to ask. The money from Friday that I'm playing with is the money I sold on Tuesday. It cleared on Thursday. So Friday morning, that 30% again was back in rotation. It will always stay in rotation as long as you stay in 30% daily. So at the end of Friday, I took 6 more day trades, 5% a piece. At the end of the day, I sold all 6 day trades at 5% a piece. That gave me a weekly total of 21 day trades for the week. An average person will take 3 day trades in a week before they can get a penalty. I took 21 won. If I broke down those 10% plays into 5% plays, I honestly could have taken 30 day trades this week with 0 penalties. So I could have taken 30 day trades this week with 0 penalties, where the average person only has 5 day trades before they get a penalty. Now, what's good about selling on a Friday is I'm going to have a great weekend. I'm going to get a lot of rest. Why? Because what I sold on Wednesday also cleared on Friday, so that 30% of my portfolio that I allocate at all times was back in my account on Friday. So Monday morning when that market opens up, Duck, I am ready to go once again. I always have 30% of my portfolio allocated in a solid rotation. It's like a round robin. It just keeps rotating as long as you stay with the plan.
All about having that plan. And even part of that trading plan is just having different trading sites and tools you can use, like investing.com, Investopedia. And one thing that we go over as well is keeping due diligence and, and using these sites to do your own due diligence, which is, super important.
Oh man, Doc, you're so right on that. So many people get into a stock, whether they follow it from a trading group or they buy it at their own search. And once they buy into a stock, some of the problems I see, once it's sitting in their portfolio, they just watch the chart. And that's it. You can watch a chart. That's incredible. That's awesome. But in my opinion, it's not over. It's like having a child. You need to take care of that child daily. Know what it's doing, know where it's sitting, know where it's going. Now, what I like to do personally, so doing daily due diligence to me is key. Like you talked about Investopedia and all these other places, I do something similar, very similar in my trading plan. If I'm holding 3 stocks, I will take each one individually, one at a time. I will put that stock name into Google, that stock name, and hit search. Any national news that pops up on that stock is going to be available for me to look through. It's going to pop up anything that was mentioned about it that's of importance. Next, what I do, which is really important, what I like to call beating the news, I'll go to like example eBond, which is eBang. I go directly to their website. What I'm looking for, I look for that tab they call investor relations. Sometimes in that investor relations tab, you can find some news on, you might have a conference coming up, you may have earnings coming up. They may have posted about a merger. They might be talking about an offering coming up. It could be a reverse split coming up. There's so many filings that are available that these companies do weekly, sometimes bi-weekly, and there's some companies I've seen that will post 2 to 3 filings in a day. Whatever it is your stock has, always look for the catalyst in your filings daily. Never give up on your stocks. Until you sell it, don't stop looking, because when you keep looking, doing daily due diligence, you will be amazed how much news is there that you might have missed that could potentially keep you from losing money, but maybe even catching a news alert after hours at 9 o'clock in the morning. You're going to know to have your alarm clock set up for 4 o'clock in the morning to take profits on that bike that you'll get at 4 o'clock in the morning. So you know, hey, I need to take this advantage of it. I seen the approval. I found it on the filings. I know it's going to skyrocket at opening, and I'm ready for it. You can secure your profits. So definitely doing due diligence daily is key to any stock.
Oh, 100%. Pennybois University, like I said, we do go over a bunch of sites that you can use. And if you are a new trader watching this, I definitely do want to let y'all know, trading, it's not easy. It's not impossible, but it's definitely possible with the right plan, the right risk reward ratio, the right risk management. I always say, it is risky. Anything, just like anything with money is risky. Nowadays trading is like kind of walking around with a loaded gun, in the sense where, all it takes is a couple clicks of a finger. If you don't know what you're doing, you can, with a gun, you can hurt someone, but with the portfolio, with like Webull and Robinhood, you can lose a lot of money pretty easily, which is why, it's not like back in the day where you had to, be a stock market trader or broker, and, you had to call your broker up in order to make a trade. Now you can just do it right here on a computer. So that's why it's really important to learn, because of how, how risky and how dangerous it can be for someone who doesn't know what they're doing.
What I see in trading nowadays is a lot of people investing their money into trades and making simple mistakes. There's nothing wrong with social media, but sometimes following certain people on social media, you get caught into what we call the hype.
Oh, yeah.
If you get into the hype and you're not sure what you're doing or what you're looking at, potentially can harm you. But if you decide to do Pennybois University, the Duck has so much available for the free education that is included with Pennybois, and actually teach you to know what you're doing instead of following random people for what they're doing. You could do it on your own.
But like Tagman was saying, we do have our free trading classes. We update these all the time with new content. You can just go to the free trading class area. This is available for Pennybois University members. This is available for free members. It doesn't matter if you're paying or not. You have access to these free classes. You can check out all about PBU. We do do 3-month programs. We have one in April, May, June, so that way you can join in on any of the months. So, if you miss the April class, you can come in May. If you miss May, you can come in June. And by the time June is over, April's going to be resetting, and you can join after June. You can join July, or whatever month you join. That's where you can join the class. It's not going to be like where you have to catch up on 3 months worth of work. When you join, you can just restart with everyone. We have our live streams in PBU every Tuesday, 2:30 p.m. Eastern Time Zone, where we go over our cash giveaways. We do the homework. We go over the homework. We do our cash giveaways. We do our trading trivia with prizes. We also go over a trading tip of the day or an indicator of the day as well in those Pennybois University streams, so definitely be sure to check that out. We have an area for PBU charting questions, PBU options questions. We have an area where you can post our Pennybois University trading plans. We have our updates from the guides area, where all the Pennybois University guides who are there to help you in the chats, they post how they've been doing, what they did right, what they've done wrong, so you can learn from them and their mistakes and their successes. We have our PBU alumni area, where if you graduate PBU, you can become a Pennybois University alumni. You get access to special chats, special streams, and special classes only made available to the alumni who pass Pennybois University. And then of course we have our ticker channels. These are different alerts that all the members are getting into. We discuss them together as a Pennybois University group. It's really cool to see how other traders are doing and how they're playing those alerts. So we go over all that in Pennybois University. And of course we go over charting. We have a whole month on candles, candle patterns, and all the different indicators. I believe we go over I think it's like 25 to 30 different indicators in Pennybois University. One thing that you can definitely check out is our PBU Learning Center. So you scroll all the way down and you can find our table of contents, where it goes over all the different things that this learning center has in it. One of which, so if maybe you either missed the stream earlier, missed what Tagman was talking about when it came to the 25, 25, 50, when he was saying 25% here, 25% here, 50% here, you might have no idea what that means. Well, go to the PBU Learning Center and you can see what our buy-in method is, which is the 25, 25, 50 rule. And you can read in detail how this all works. And for us, what our 25, 25, 50 rule basically is buying in slow, because we aren't chasing stocks. We're getting into stocks before everyone else starts talking about them, which means we're getting into them while they are consolidating, meaning trading sideways. They go up, they go down a little bit before they start really making that upward movement. What we're doing is we're buying in small and taking advantage of the small dips to build the best average possible, while at the same time limiting our risk. So, you get into the stock, you buy in, it could be 25%, it could be 10%. And when I say percentages, I mean percentage of what your intended position is. So before you get into a play, you want to know how much you're going to be buying or how much money you're going to be putting into that stock. So if I want to put $100 into a stock, let's say I want to buy in with 25, 25, 50, that means I'll do 25%, 25%, 50% of $100. So $25, $25, $50. So my first buy will be $25. I'll wait for a nice little dip, a nice little support that I find, and I'll buy another, $25. And then I'll wait for some upward confirmation or a reversal using the charts that we go over and all the indicators we go over in Pennybois University. I can find a confirmation of a reversal, and that's why I put my last buy in and I ride the wave up and I make profit and I'm happy, and put that money into my investing account and use that to make more money, or whatever it may be, whatever your plan is. Like I said, everyone's plan is different. But yeah, you can go over that. We also go over some miscellaneous trading tips, and we go over how to trade with a cash account. So maybe you missed how that worked in the stream with Tagman. Well, you can just go to the PBU Learning Center. It's completely free, and you can see these examples of how cash account trading works. Remember, you do not have to have 25K in your account, and you can get this on Webull, and this way you can make as many day trades as you like, as long as you follow some guidelines. You will not get a good faith violation or any trading or any day trading penalties. And you can definitely check us out at Facebook. That's facebook.com/group/btpenny. So that's pretty much how Pennybois University works. And this has been your Trading with Tagman. And once again, Tagman, if you want to say anything else to these new traders before we head out.
Yeah, Duck, I thank you for coming on. It was a great working together with you, and you're an amazing teacher to our Pennybois University. The stuff that they are taught, and we always try to teach people. One of the main things is, please, everybody, remember about your emotions. Remember about understanding the value of a dollar. Please take notes of your plays. Make sure you set yourself up a trading plan and follow it accordingly. Make sure you're buying in slow to your trades. And thank you, everybody, for coming out. And we're glad we were able to answer all your questions throughout this stream. Hopefully, you guys are successful with your trading starting tomorrow and made some little adjustments. Hopefully, we were able to help you out. Everybody have a great evening. Remember, here at Pennybois University, we're not just traders, we're family. Let's keep it real. Let's keep it friendly. Let's stay together. Love you all.
Yeah, that was Trading with Tagman, and I am What the Duck. But yeah, until then, hopefully I see you in Pennybois University. But as always, until then, I hope that you all make some bread.